All right, today we're going to unpack a really detailed financial report on a fascinating tech company that's just riding this massive wave of digital transformation. So let's get right into the investigation.
So, let's kick things off with a huge number. According to the report we're looking at, this is the projected size of India's fintech market by 2025. I mean, that's an enormous playground with just incredible potential for growth.
And that's the big question for any investor, right? Financial analysts try to figure that out by digging deep into the companies competing in that space. And that is exactly what our source report does.
To find a potential winner, you've got to know who's even in the game. So let's meet the company at the center of this report.
Meet Aurionpro Solutions. At its core, this is a company that helps banks, cities, and other big businesses modernize and go digital. It's best to think of them as the architects working behind the scenes of our more and more digital world.
Okay, so that's the 30,000-foot view. But to really understand a company, we need to pop the hood and see exactly how it makes its money.
So their business model is pretty diversified. The biggest piece of the pie, a full 60%, comes from banking and fintech. That's their real bread and butter. The other major parts are building out infrastructure for smart cities and providing software for big enterprises.
And get this, check out their global scale. While Aurionpro is a major player in India, a whopping 65% of its business comes from over 45 other countries. So yeah, this isn't just a local story, it's a global one.
All right, so we know what they do and where they operate. But is the company actually healthy? Let's treat this next section like a doctor's checkup and take a look at the company's financial vitals.
And right off the bat, the first vital sign looks incredibly strong. You see this consistent, impressive growth over the last 5 years, right across the board. Revenue alone has a 28.5% compound annual growth rate, or CAGR, which is just a fancy way of saying that's the average yearly growth over that period. And trust me, that is nothing to sneeze at.
Now, here's a number that gets investors really excited: 78%. That's how much of Aurionpro's revenue is recurring. You can think of it like a subscription model. This high level of predictable income gives them this incredible stability, which is a massive, massive plus.
Next up, we have the return on capital employed, or ROCE, at 22.1%. All this really measures is how efficiently a company uses its money to generate profits. And a number this high? Well, it suggests management is excellent at turning capital into cash.
And finally, just look at this, a debt-to-equity ratio of only 0.16. I mean, that is extremely low. It means the company isn't weighed down by a ton of debt. It's got a rock-solid balance sheet and very low financial risk. For a tech company in a fast-growing market, this is huge. It gives them the freedom to invest and innovate without being tied down by lenders.
You know, the source report sums up this whole financial checkup perfectly with this one quote: "The company's vitals aren't just good, they're excellent."
But hey, a good investigator considers all the angles, right? The report also dives into what the wider investment community is saying, both the good and the bad, the bull case and the bear case.
So this lays out the two competing arguments. You've got the bulls, the optimists, pointing to that massive fintech opportunity, the stable recurring revenue, and management's great track record. Then you have the bears, the pessimists, and they're worried about the high valuation, some intense competition, and maybe relying a little too much on a few big clients.
And this really gets to the heart of the debate: valuation. The company's price-to-earnings ratio, which just compares its stock price to its earnings, is 29.1. So the big question the market is asking is this: are the company's growth prospects strong enough to justify paying that kind of premium, or is the stock just too expensive?
Okay, we've reviewed the business, we've checked the financials, and we've heard the public debate. So after weighing all that evidence, what's the report's final verdict?
And there it is. The report's recommendation is a clear and direct buy.
But the analysts don't just stop at buy. They provide a specific target price of 1,450 rupees. And based on the price when the report came out, that represents a potential upside of over 17%.
Their confidence really comes back to these core strengths we've been talking about. They're a market leader, they've proven they can execute, they have that stable recurring revenue, they're global, and they have that rock-solid balance sheet.
And that brings us to the final question, really. The analysis reveals a powerful growth engine, no doubt, but the market knows this and has priced the stock accordingly. So the ultimate question for any investor is this: is all of that future success already baked into the price?